Something big just happened, and if you blinked, you missed it. Silver didn't just pull back, it fell off a cliff. We're talking about spot silver opening Monday around $81 to $82 an ounce, more than 30% below last week's 121.64 peak, after tagging an intraday low near 71. That kind of damage in days, not months. And here's the thesis you need to hear right now. This drop wasn't random fear, it was mechanical. Both the CME Group and multiple clearing brokers confirmed margin requirements jumped roughly 36%, forcing liquidation as global markets reopened. Stay with me, because I'm going to show you how to spot this before it happens again, and why early bounces can be traps. If you're holding silver right now, or watching from the sidelines trying to figure out what this means, your job is to understand the machinery that creates moves like this. Not the narratives, not the hype, the actual mechanics. Because when you see the pattern, you'll know when it's happening again before most people even realize what hit them. Before I explain what caused this move, let me teach you something most people don't really understand about futures markets. When you trade leveraged contracts, you're renting exposure. You're not buying silver outright. You're borrowing the right to control it, and that rent can change overnight. Think of margin like the security deposit on an apartment. If the landlord suddenly triples it, it doesn't matter how much you love the place. You either come up with the cash immediately or you're out. That's what margin hikes do. They don't care about fundamentals, narratives, or your conviction. They only care about math, and when that math changes fast, price follows whether you like it or not. Now, when exchanges look at risk in commodities markets, they look for volatility first. They're not thinking about whether silver's going to the moon or crashing. They're thinking about how much it's moving per day and how much capital they need in the system to cover potential losses. So what does that tell us? It tells us that when silver rockets from $80 to $120 in a matter of days, the exchange isn't celebrating. It's calculating. It's asking, what happens if this moves another 20% overnight? Can we cover that exposure? And if the answer is no, they act. They raise margin requirements. They don't announce it weeks in advance. They don't ask for your opinion. They just do it. And when they do it during a parabolic move, they're essentially pulling the emergency brake on leverage itself. Here's what you need to understand about leverage. It amplifies everything. When silver's climbing, leverage makes winners feel like geniuses. But when margin requirements change, leverage becomes the problem. You're not just dealing with price risk anymore. You're dealing with cash flow risk. Can you post more collateral today? Not next week, today. And if you can't, you don't get to wait and see if silver bounces. You get liquidated. The position closes. The trade's over. If this is making sense, drop a comment below and let me know where you're watching from, because this pattern shows up in every market, and understanding it early separates people who survive volatility from people who get wiped out by it. Now here's what's actually happening under the hood. Let me break down the sequence, because this is where the story gets mechanical, and once you see it, you can't unsee it. First, silver rockets to over $120 as leverage piles in. Open interest swells. That means more contracts, more exposure, more bets on the same move. Volatility spikes. You're seeing $5, $10, $15 moves in a single session. Then the exchange steps in and raises margin requirements by roughly 36%. That's the primary driver. Overnight, every leverage trader has to post more capital just to keep the same position, not to add to it, just to hold what they already have. Second, global markets reopen into that higher requirement, and anyone who can't meet it gets a margin call. They don't get to negotiate, they sell. Third, those forced sales push price lower, which triggers more margin calls, which creates a cascade. That's the convergence. And here's what's wild about this. The selling has nothing to do with whether silver is worth 80 or 100. It's purely mechanical. Let me paint the picture more clearly. Imagine you're long silver futures at $115. You've got 20 contracts. You posted your initial margin. Everything's fine. Then you wake up Monday morning, and the margin requirement jumped 36%. You now need to wire in tens of thousands of dollars more just to hold that same position. Maybe you've got the cash. Maybe you don't. Maybe you've got the cash, but it's tied up in other trades, or it's in a bank account you can't access immediately because markets are opening in Asia before US banks are even open. What happens? You get liquidated. Your broker doesn't call and ask nicely. They close your position at market. And when thousands of traders are getting liquidated at the same time, what do you think happens to price? It doesn't drift lower. It gaps, it cascades, it waterfalls, and that's exactly what we saw. Silver opened Monday around 81 to 82, nowhere near where it closed Friday. That gap is forced selling. That's not sentiment, that's survival. But here's the part that should make you nervous. Some commentators are calling this engineered, pointing to the timing of the margin hike, chatter around JPMorgan Chase positioning, and even temporary disruptions at the London Metal Exchange and HSBC. Whether you buy that or not, the effect is the same. Weaker leveraged hands get flushed first. The people who can't meet the higher margin requirements are gone. The people who can meet them but don't want to hold through more volatility, they're gone too. What's left? Less leverage in the system, lower open interest, and a price that's searching for a level where real buyers actually want to own physical silver or take new positions. And that process doesn't happen in one day. It doesn't happen in one bounce. It takes time. Now let me show you what very few people are talking about. When margin hikes hit during a parabolic move, they create a two-way problem. On the way up, everyone's piling in because price is rising, and rising price attracts more buyers. That's momentum. That's FOMO. That's leverage feeding on itself. But when the exchange steps in, it cuts that feedback loop instantly. The buyers who were driving the move higher can't hold their positions without posting more cash. So they're not buying anymore. They're selling. And the new buyers who might step in, they're looking at the carnage and thinking, why would I chase this now? I'll wait. So you get this void. No buyers on the way down to absorb the forced selling. That's when price doesn't just correct, it craters. And that's mechanical, not emotional. The fundamentals didn't vanish overnight. The story didn't change. The leverage just got reset. This is the exact same playbook we've seen before. Zoom out and you see the pattern. In 2011, after silver's blow-off top near $50, the first Monday didn't mark a bottom. It marked more volatility and deeper retests. Silver chopped around for weeks before finding any kind of stable base. And even then, it eventually worked its way much lower over the following months. What happened next? Forced liquidations, margin hikes, cascading selling, and a market that needed time to digest the excess leverage before anyone could call a bottom with confidence. Same pattern we're seeing today. Let's go back further. In March 2020, after the initial crash when COVID hit and everything sold off, early rebounds failed before stability finally showed up. You remember that move. Silver dropped from $18 to low 12s in a matter of days. Then it bounced hard. Everyone thought, okay, that's the bottom, but it wasn't. It retested. It chopped. It took time for volatility to compress and for real buyers to show up with conviction. Every time margin pressure collides with reopening liquidity, you get chop, not clarity. You get false bounces that trap early buyers. You get volatility that feels like opportunity but is really just the market shaking out weak hands. And here's another example that's even more relevant. In 1980, when the Hunt brothers tried to corner the silver market and silver spiked to $50 an ounce, what happened when exchanges raised margin requirements? The exact same cascade we're watching now. Forced liquidations, collapsing price, legal battles, and a market that took years, not months, to find a real base. Now, I'm not saying silver is going to take years to recover this time. I'm saying the pattern of margin-driven liquidation is consistent across decades. When you look at those charts, the larger story is this. Bottoms take time. They require volatility to compress, not just price to bounce. And history says the first bounce is usually the loudest liar in the room. So what's the lesson here? When you see a parabolic move followed by a margin hike, don't assume the first drop is the only drop. Don't assume the first bounce is the bottom. The mechanics of leverage take time to unwind. The system needs to reset. And until that reset completes, you're trading in a minefield. You might catch a bounce. You might get lucky. But you're not investing. You're gambling on timing. And the house has a much better view of the order flow than you do. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could all this talk about manipulation be overstated? Absolutely. Markets don't need villains to move. They need imbalances. Margin hikes are a standard risk control tool, not proof of a grand conspiracy. Exchanges raise margin requirements all the time when volatility spikes. It's in their rule book. It's their job to protect the integrity of the market and ensure they can cover losses if someone defaults. So is it suspicious that they raised margins during a parabolic move? Not really. That's exactly when you'd expect them to raise margins, when risk is highest. And big banks being positioned? Sure, JPMorgan might have a large position in silver. They probably do. They're one of the biggest players in commodities. But being positioned doesn't automatically mean they pulled the strings. It means they saw the same setup everyone else saw, and they acted on it with more capital and better execution than retail traders. Could there be coordination? Maybe. Could there be front-running? Possibly. But here's the thing. It doesn't actually matter whether this was engineered or organic. The mechanics are what matter. The outcome is the same. Margin requirements went up. Forced selling happened. Price collapsed. Whether that was intentional or just market structure doing its job, you still have to navigate the result. So here's my take on the conspiracy angle. Focus on what you can control. Watch liquidity. Watch volatility. Watch how price behaves around key levels. That's where your edge lives, not in guessing motives. You can spend all day debating whether big banks manipulated silver, or you can spend that time learning to recognize when forced liquidation is happening and position yourself accordingly. One of those approaches makes you money. The other one makes you angry on Twitter. Your choice. There are probably three types of people watching this right now. Maybe you're the long-term believer who loves silver's fundamentals and feels shaken but still convicted. I get it. You've been stacking, you've been buying, you believe in the story, you believe in monetary debasement, inflation, central bank policy, all of it. And watching silver drop 30% in days feels brutal. It feels like everything you believed just got invalidated. But here's what I want you to hear. The fundamentals didn't vanish. The leverage did. For you, the key is patience. Let the forced selling finish. Let the market show you stability before adding risk. You don't have to catch the bottom. You don't have to be a hero. You just have to avoid getting shaken out at the worst possible time. If silver's going where you think it's going long term, this pullback is noise. But noise can still hurt if you're over-leveraged or emotionally compromised. So take a breath, step back, wait for confirmation. Maybe you're the short-term trader who got whipsawed and wants to jump back in on the bounce. You sold into the crash, or you got stopped out, and now you're watching silver bounce from 71 back to 80, and you're thinking, this is my chance to get back in. Slow down. Ask yourself, is selling pressure actually easing into the US close, or is this just a reflex rally? Are you seeing volume decline on the bounce? Are you seeing volatility compress? Or are you just seeing price pop because everyone who got liquidated is now scrambling to buy back in out of FOMO? Reflex rallies are dangerous. They feel real. They feel like opportunity, but they're often just short covering or bottom fishers getting picked off. If you're going to trade this, trade it with tight risk and clear invalidation levels. Don't chase. Don't hope. Execute with discipline or sit on your hands. And maybe you're on the sidelines entirely, trying to learn. You didn't have a position. You're not emotionally invested. You're just watching and thinking, what can I take from this? This is your moment. Study how margin changes create cascades. Study how support zones form, like 80 to 82 as immediate support and 70 to 75 as a deeper washout area. Study how volatility behaves after forced liquidation. This is live market education. This is a case study in leverage, risk management, and market structure. Different styles, same principle. Confirmation beats conviction. Wait for the market to prove itself before you act. So here's what I want you to answer in the comments. Where are you right now? Are you holding? Are you watching? Are you trying to time a re-entry? And what's your biggest question about how to navigate this? Because the more context I have about where you're at, the better I can tailor future content to help you see these setups earlier. So here's where I stand. I'm not chasing bounces, and I'm not calling a bottom just because price looks cheap compared to last week. I'm watching three things closely. First, I'm watching whether silver can hold that 80 to 82 zone without heavy volume selling. If price sits there and volume dries up, that's a sign forced selling is finishing. If price breaks below 80 on heavy volume, that tells me there's more liquidation to come, and we're likely headed toward the 70 to 75 zone for a deeper washout. Second, I'm watching whether volatility actually contracts instead of expanding on every move. If we get a bounce and volatility spikes higher, that's a warning sign. That's chop. That's instability. But if we get a bounce and volatility starts to compress, that's the market finding a range. That's the beginning of a base. Third, I'm monitoring how price behaves into the US close, because real bottoms show exhaustion, not just relief. Exhaustion means price stops going down even when sellers are still trying. Relief means price bounces on hope. One of those is tradable. The other one is a trap. Based on my analysis, this move was structural and mechanical, not emotional. The fundamental picture hasn't changed overnight. Central banks are still printing. Governments are still spending. Inflation is still a concern. Industrial demand for silver is still growing with solar, electronics, and green energy. None of that disappeared. What disappeared was excess leverage. And when leverage unwinds, price resets. That doesn't mean the trend is broken. It means the trend got ahead of itself and now it's correcting. If history rhymes and silver finds a base in this 80 to 82 zone or tests lower into the 70s before stabilizing, the move that follows could be substantial. But that base has to form first. And forming a base takes time, not hope. Let me tell you what I'm not doing. I'm not buying just because price is down 30% from the highs. Down 30% doesn't mean cheap. It means 30% lower than it was. Price could go down another 30% from here and still be above where it was 6 months ago. So I'm not anchoring to last week's high and thinking, wow, what a discount. That's recency bias. That's emotional thinking. I'm looking at structure. I'm looking at volume. I'm looking at whether the market is showing me signs of stabilization or signs of more pain. And here's what I'm definitely not doing. I'm not listening to anyone who's calling this the bottom with certainty. Nobody knows where the bottom is. Not me, not you, not the analysts on Twitter who are posting charts with lines drawn all over them claiming they predicted this. If someone tells you they know exactly where silver is going next, they're either lying or delusional. What I can tell you is how to watch for signs that a bottom might be forming. And those signs are volume, volatility, and price action around key levels. That's it. That's the signal. Everything else is noise. I'm not a financial advisor. This is not financial advice. Do your own research. Verify everything I've said. Check the CME data on margin requirements. Look at the historical precedents I mentioned. Make your own decisions based on your own risk tolerance and your own time horizon. I'm showing you how I'm thinking about this move and what I'm watching. That's education, not recommendation. If you made it this far, you're the kind of person who thinks independently and doesn't just follow the crowd. That mentality will serve you well, especially in markets like this, where everyone's emotional and nobody's thinking clearly. The people who survive volatile markets aren't the ones who chase every move. They're the ones who step back, watch the structure, and wait for confirmation before they act. If that's you, I want you to do two things. First, share this video with someone who's trying to understand what just happened to silver. They need to hear this. Second, subscribe if you haven't already, because I'm going to keep breaking down these patterns as they develop. The market's not done, this story's not over, and if you want to stay ahead of the next move, you need to be here when it happens. I'll see you in the next one. Stay sharp out there.